proposed spin-out to Halo Tech, Inc., delays or unforeseen costs incurred in connection with construction, the ability of competitors to scale operations in Northern California, delays or unforeseen difficulties in connection with the cultivation and harvest of Halo's raw material, changes in general economic, business, and political conditions, including changes in the financial markets. These risk factors are discussed in detail under the heading Risk Factors in Halo's Annual Information Form dated March 31st, 2022, and Halo's additional disclosure documents filed on SEDAR. New risk factors may arise from time to time, and it is not possible for management to predict all of those risk factors or the extent to which any factor or combination of factors may cause actual results, performance, or achievements to be materially different from those contained in forward-looking statements. Given these risks and uncertainties, investors should not place undue reliance on forward-looking statements as a prediction of actual results. Although the forward-looking statements contained in this presentation are based upon what management believes to be reasonable assumptions, Halo cannot assure investors that actual results will be consistent with these forward-looking statements. The company undertakes no obligation to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise other than as required under securities legislation. With all that being said, I will now turn the call over to Philip Vandenberg, our Chief Financial Officer.
Okay, thank you, Katie. I'll take you briefly through the highlights of the year and the 3 months. I said Q4 revenues were $8.4 million. For the full year, it was $36.2 million. They were respectively 63% and 16% increases. Excluding acquisitions, growth in Q4 was flat versus Q4 2020, and up 3.2% for the 12 months. The sales in the last year, 2021, were 32.5 million grams, 13 million grams for Q4, and they were 381 and 345% increases. The average mix price decreased with 63 and 65% respectively for the full year and 3 months, and that's really because of a higher proportion of flower sales. Q4, the gross profit was minus 1.3 million, and in Q4 it was in Q4, and then 4.5 million profit for the year. Adjusted for impairments and biological assets, the adjusted gross profit for the Q4 was 800,000, and for the year it was 7.3 million profit. The gross margin reported in Q4 was minus 16.1%, and it was plus 12.3% for the year. And adjusted for impairments and biological assets, the gross margin was 9.6% in Q4 and 20.1% for the year. We sold 6.4 million grams of flower. We sold 1.3 million grams of pre-rolls. We sold 16.5 million grams of trim and fresh frozen. We sold 7.3 million grams of oil and extracts, and we sold 1 million grams of edibles in 2021. Turning to the operations, A&M revenues were 2.4%, which was a year-on-year minus 41% decline, Q-on-Q minus 35%, and for the full year it was minus 10%, basically showing that Oregon was a tough market in 2021, in particular in the second half. Sales were 5 million grams, which was plus 6.6%, and in terms of volume, and prices declined with 15.6% year on year. Sales were 0.9 million grams for the 3 months, which was a volume decline of 36% year on year, and prices were down 8%. A&M reported a gross loss of 652,000 for the 3 months, and a gross profit of 254,000 for the year. And adjusted for biological assets and impairments, the adjusted gross profit for A&M was 83,000 and 1.8 million for the year. Coastal Harvest revenues were in Q4 were 1 million. For the full year, they were 2.2 million. Coastal Harvest sold 2.1 million grams for the year. There was no activity in 2020 really, and 340,000 grams were sold in the 3 months. The gross loss for the 3 months was 50,000, and for the year it was 318,000. And then adjusted, it was a loss of $1,600 and gross loss for the year of 269,000. Mendo's revenues were 3 million for the quarter. For the full year, they were 9.9 million. Sales were 14.3 million grams for the year, and versus 1.8 million grams in 2020, so a big increase. For the 3 months, sales were 7.3 million grams. The gross loss was 737,000 for the 3 months, and there was a gross profit of 854,000 for the year. And adjusted for impairments, the gross profit was 91,000 for the 3 months and 1.7 million for the year. Flowers, that was Mendo. Then Winberry. Winberry revenues were 3 million for the quarter, and for the year they were 9.9 million. Winberry sold 11 million grams of flour and oil, and 4.4 million grams in Q4. And there was Winberry was not consolidated in 2020. The gross loss for the 3 months was 523,000, and there was a gross profit of 3.4 million for the year. And then adjusted for impairments, the gross profit was 10,000, and then for the year it was 3.9 million. Turning to operating expenditure, OPEX for the 3 months was 11 million. Of that 11 million, 3.9 was non-cash. And taking away acquisitions, in 2021, the like-for-like OPEX was actually 7.6 million. OPEX for the 12 months was 43.2 million, which was a 92% increase. Of this, 15 million was non-cash, and like-for-like OPEX for the 12 months was actually 30 million, and there was an increase of 35%. Of total operating expenditure, Akanda was 3.6 million, and Akanda was deconsolidated in November. And then acquisitions, they added in total 3.4 million to operating expenditures in Q4, and they added 30 million for the year. Then the deconsolidation of Akanda and the decline in production overheads, they are expected to reduce our costs going forward with at least 3.3 million on a forward basis. EBITDA, there was an EBITDA loss of 12.3 million, and adjusted for impairments and biological assets, it was a profit of a loss of 7.1 million. For the year, it was minus 38.7 million, and adjusted for impairments, it was 23.6 million. Cash flow. The net loss in Q4 was 66.5 million and 96.9 million for the year. That includes impairments of 60 million. Non-cash items were 56.7 million and 69 million for the year. Working capital was plus 2.9 million in Q4, and was a release of working capital of 7.6 million for the year. Total cash used in operations was 7 million and 35 million for the year. Cash raised from finance was 1.4 million and 33 million for the year. Total cash flow was total cash flow was 6.7 million of cash outflow and minus 1.8 million, so an outflow of 1.8 million for the year. And then the cash burn per month, based on the Q4 numbers, was 2.3 million per month. Balance sheet. At the end of the year, the company had 1.8 million in cash, which is pretty much where we are today. Debt was 18.9 million, net debt 17.1 million, and the net debt to equity ratio was 26%, so a pretty healthy balance sheet. And then in terms of debt, we had short-term debt of 9.7 million, which was really the move of the 2019 convertible from long-term to short-term, and that in the end was actually restructured. And then there were also 6.9 million of other loans. And on long-term convertible, there's still 1.3 million, which is the convertible with high tide, and other loans of 1.1 million. The capital structure. The company had at the end of the period had 24.1 million shares outstanding. 6 million shares were issued for private placements at the value of 31 million. 7.2 million shares were issued for acquisitions at a value of 54 million. And the share capital at the end of the year was 232 million, with net assets of 66 million. And as I mentioned before, included in there is our impairments of acquisitions done in 2019 and 20 and 21 of 60 million. Impairments of intangible assets were in that number were 40 million. Goodwill impairments were 12.7 million. And then acquisitions that hadn't closed but were written off were 7.4 million. And that is basically the two retail assets. The auditors told us to write them off, but haven't even closed yet. So that is actually, you'll find that in the financials in deposits. So there was a figure of 7.4 million. Then in our capital structure, right now we have, at the end of the year, we had Akanda, which was deconsolidated in November. And at the end of the year, that investment is now a long-term investment for the company, and that was valued at 11 million. If I take today's IPO price, where the stock is, not the IPO price, but where the stock is trading, that stake is worth more than $100 million. And then in our capital structure, we have a facility with a debt provider of 14 million, another one with the same group of 50 million, and then we still have a note with Akanda, which is worth about 6 million. So the company has a lot of resources to fall back on. Very briefly, acquisitions. In Q1 we did 2021 we did Winberry, the two retail assets, SDF and ZXC. Then also their management companies, Black and Crimson and POI. All that, like all those, excluding Winberry, they were actually written off. That's what the audit firm told us to do. In Q-Firm, Nature to Best was closed, and also a numbered company, 1307296, that had to do with Elegance. The first one, Nature to Best, that was pretty much written down, and Elegance. We ended up with $7 million of shares in Elegance. They are not written down, they're still in the balance sheet. In Q3, we closed High Tide. We also closed Food Concepts as part of a deal with Pistol Point. Pistol Point itself hasn't closed yet, but Food Concepts has. And then Williams Wonder is not closed yet, but was also done in Q3, and then in Q4 we only did one acquisition, which was simply Sweet, and that pretty much concludes my presentation. Thank you.
Thank you, Philip. Now we have time we actually have 12 questions. Some of them have a couple different parts, but what we'll do is I'll go through them, read the question, and then direct it to the appropriate member of management. All right. So the first question, actually, Kieran, is for you. And some folks were wondering about your health, just in terms of the way when you're speaking, it sounds like your voice is different. So would you be able to comment on this?
No, sure. I've had some dental work done, and my voice will be different for the next 2 to 3 months, and then it will return to normal. But I'm feeling fine and fit.
All right, this next question is regarding, essentially, it's about Aconda and why the value is not reflected yet. And so, Philip, you had touched on this a little bit in terms of what we're expecting, but can you just solidify the answer? What is our explanation why the Aconda value is not reflected yet in Halo?
Okay, the IPO of Aconda happened literally just a few weeks ago, or 2 weeks ago, at a price of $4. Our stake, when we ended up with the shares, and we had to be below 50%, we had to sell some shares. We sold those at $1. So therefore, our position is valued at $1 and not $4 let's say at the year end, because the IPO happened thereafter. So comes Q1, then we will do a mark to market, and then the IPO price was $4, but right now the price is closer to, I think it's about $8, and that would value the stake in Q1 at more than $100 million. But because we sold shares at $1, that was the last transaction price. We had to value it at that price, and therefore the stake was then void.
Kieran, this next question is for you. One thing that we mentioned maybe in the press release or during one of the interviews recently is, along the lines of the sale of Aconda and how that all came to fruition. And you mentioned that Halo would consider selling any business if it makes sense for the shareholders. The question here is, how will we determine whether that in fact makes any business sense for the shareholders?
From my perspective, selling off the business would only make sense for shareholders if such business, after 280E taxes, which are the punitive taxes, was all subject to in the U.S. marijuana industry, if those proceeds are at least equal to or higher than the book basis of our assets. People have said, distribute the Aconda shares under securities laws. That's not possible. Another way maybe to do it, which we're looking at multiple ways, but one way to start giving shareholders Aconda's value is maybe to put the shares in some sort of closed fund or some other mechanism, or sell the shares, which we're not interested in doing, and we're locked up for 9 months. 9 months and then half in 12 months. So we would look at somehow returning some of that value to shareholders, but Aconda, based on our meetings with Tage, my conversations with Louisa, is just setting on a path, and I think that they have a chance to be a dominant player in Europe with everything they have lined up.
Okay, great. This next question is about the recent announcement of the convertible note financing and whether or not it will cause dilution. Retail shareholders were hoping that Aconda's IPO could trigger a turnaround for the stock price, and they are concerned that the conversion of the note could mitigate that effect. So what are your thoughts on this, and does essentially management recognize that continuing to dilute is not a good strategy?
Who is that for?
That's for you, Kieran. Sorry.
Okay. So I think our pace of acquisitions are slowing down, and where possible, now that we have some credibility possibility, or I'd say a considerable amount of credibility with potential acquisitions. I think that one of the strategies we would like to deploy is substantially less shares and more leverage secured by the assets we buy. Because besides small little tuck-in investments here and there, some of the assets we're looking at are in many ways substantially larger in value than us. So by way of example, if we find an asset, and this is just an example, worth $100 million, I would love to be able to pay, $10 million in stock and $90 million in debt secured solely by the assets we buy, sort of a leverage buyout technique. So that's what we're looking at if we go forward with large investments. The other thing we have is we have a couple of facilities at hand. Prices in our two markets, Oregon and California, are coming down substantially and continue to come down. So we haven't pulled the trigger on anything major yet because it's like catching a falling knife as prices continue to compress. One area we're not seeing price compression right now, or as much price compression, is in retail. So our focus is dispensaries. And for the first time, I can say that we're open to also acquisitions in Oregon if they make sense of dispensaries.
Yes. Okay, so this next question was for me, but I think we can all chime in on it. It was just, what is our take on business strategy for 2022? So to kind of piggyback on what Jern was just touching on there, we're definitely focused on continuing to verticalize, particularly in California, but where it makes sense to do so in Oregon as well. In California, we're laser-like focused on, now that we have one of the stores opening the next 2 stores. In addition, because of market conditions, there are some attractive tuck-in store acquisitions, and we think that because the retail prices are less sensitive to market conditions than wholesale, this is going to be a great way to just secure revenue and improve our margins. So that's part of the strategy. But in addition, and this is something that we touched on in our earnings press release, that selectively incubating assets that are either non-plant touching or standalone is a great way of creating value as we for the concept. And we have a couple of those that are in the works, one which is quite far along. And so, Philip, maybe you would like to talk a little bit about how we're executing this incubation strategy with Halo Tech.
Sure. So what happened is we bought assets, basically 6 companies with a total value of around 20 million. Those companies we are going to put together in one new company called Halo Tech, and that company is basically a return to shareholders as a return of capital. So where we have 20 million, we know what that represents as the book value of the total. So we can actually then calculate how many shares of Halo that involves. Then we issue shares in Halo Tech, so you have a share exchange ratio, and every investor in Halo Collective will end up with shares in Halo Tech as a distribution of capital. And those shares are going to be listed, and we're literally in the middle of signing off everything. Like we have had separate audits for the companies in Halo Tech. Halo Tech itself has had an audit, so that company is now exists, and that company is going to be listed. And we have nearly completed a prospectus, which hopefully we will actually complete this week. To get those shares listed on the CSE. That's in progress. So this is different than, let's say, Akanda, where Akanda is an outside company where we vended in assets. In this case, it's actually, it's not an outside company. It is Halo Tech, is owned by Halo Collective and distributed to shareholders as a return on capital. And that is, let's say the prospectus is imminent. And then it takes, for the regulator, the exchange, it takes about 2 months to allow this to happen. So I would expect that in 2 months' time, Halo Tech has its own listing.
That's great. And I think another area, just to elaborate on how we can see this potentially playing out this year, Halo has also acquired or /developed assets that are non-plant touching CBD, non-plant touching CPG, so non-plant touching consumer packaged goods. And by that, I mean some of the functional mushrooms, formulations for CBD or non-THC gummies, things of that nature, including a manufacturing and distribution agreement with FY Energy Corporation. So things of this nature, we're realizing, again, they have a different, supply chain, different distribution, and potentially could, under the right set of circumstances, flourish potentially as a standalone. So that's an example of another area of the business we're contemplating. And the only other one that I would say, although it's a little too premature, is things still need to kind of clarify with local licensing, and in addition, the market in California, and just clarification of how much capacity there'll be this year. But that's something in theory that we might look at doing with Triangle Cannacorp as well. So these are just examples of, Karen, I don't know, do you have any other examples that you would touch on?
No, not at this point.
Okay, great.
I mean, we're looking, at other opportunities in other geographical regions like we did in Africa and Europe, but it's very preliminary. Akanda gave us a lot of hope, and, how do I say this, and tangibility that, that the whole incubation and spin-off strategy has some legs in it, so we're going to run with that concurrent with operating our businesses in Oregon and California.
Yep. Okay, great. So the next question would be, this is kind of another sort of somewhat related question, Karen, for you. And the question is, when would Halo potentially consider simply being a holding company for the Akanda shareholding or other standalone companies like Triangle, and stop any further day-to-day operations?
When we get good offers for our Oregon and California businesses.
Yeah.
Right now, it's tough times, so I'm sure there are going to be people who are poking around to buy low and then sell high. I think right now, we're at the downturn of a cycle, and, those people who survive the cycle will come out stronger. And lots of the marginal players are starting to already or have faded.
Yeah. This question, again, at least I think shareholders or investors are thinking just in general, this whole incubation and what we've done with the condos got them thinking a lot. And so this next question relates to it as well, which I will comment on, which is whether it makes sense to bring Triangle public if the California cannabis market is so low. And I would say we absolutely recognize that, and sort of in hindsight, we think it was a blessing in disguise that Triangle didn't start up this year, given what happens with prices in the California market, really across the West Coast, but certainly California experienced precipitous price declines. So I would say we're absolutely mindful of that, and by no means do we think that now is the time, but what we have learned is that there are potentially some encouraging trends. The state is changing, the regulatory licensing is requiring companies to either convert provisional annual licenses or only be granted annual licenses, which
In California.
which is a much, much higher bar. Takes more time, energy, money, resources, and for cultivation, it nearly always takes a CEQA compliance, which is a pretty onerous process. So further, it seems like the state is also moving towards limiting contiguous acres, meaning that large growth, large capacity, unless they've already been in the pipeline, will not be as plentiful in the future. What all this means is that we believe, although, again, we're just monitoring it for the moment, that the supply chain could be restricted, or not restricted per se, but not as open. And going forward, prices will come back, and at that point, it may very well make sense to with a season under our belt potentially this year, execute an IPO. So again, these are very, this takes time. All of this takes time to do, but we agree that California, this is not the right time to do it. Certainly not this past year, and we'll be monitoring it going forward. Okay. Next question, Philip, is for you. It's more general about losses for our reported in our annual filing. We reported losses for 2020. However, our output increased. How is that possible? Is cannabis growing just not a good business? And what are your overall thoughts on the business segment quantity increasing, but profitability going down?
Sure. I think there are a few elements in there. Like one is, if you go through it, it is gross margin, overheads, and then it is a lot of non-cash items. Our gross margins, they should improve. And we're working on that. And that has to do with, first of all, some things disappearing, such as Akanda, which actually has no revenues. So just by taking it away, that cost disappeared, but no revenues disappeared. So that will improve the situation. That's just one example, but we have more of those. And then prices continue to go down. At the same time, the price of trading is going down too. So in a way, the contribution margin of the products that we produce and sell should actually not be affected. It is affected, however, because of production overheads, and that's an area that we are looking at to bring costs down further and basically improve our gross margin. And then we continue to look at overheads, let's say the corporate overheads. A lot has been done already. One example is that all executives are no longer paid in cash but shares. So although you see a large number for overheads, like 50% of that is basically paid in shares to consultants, to people who work in the company. So it's not all cash outflow. And then and that's just accounting. Like we did a lot of acquisitions, like 15 or 16, and then it depends on like when you do those acquisitions. If you do them later in the year and there are no revenues yet, then you have to have very strong assumptions. Otherwise, the audit firm tells you have to pair them, basically mark them down. That's what has happened to many of those acquisitions that we did. I give you an example. Like we had to, in last year's audit, we had to write down LKJ, which is the North Hollywood dispensary. So that dispensary opened 2 weeks ago and is doing really, really well. So we may have to write them down in terms of accounting, but in the end, they do come back with revenues and EBITDA once they're up and running, and that's how they then start contributing, and that is reflected in, I think, in the market cap. So yeah, it is all you're running very hard in a way to stand still in this business, and that's what we do. We're continuously looking at alternatives. We're continuously looking how to bring down costs and how we can turn this into profitability. And although I know that the loss looks very big, like it's $60 million of non-cash, which is really just impairments on acquisitions that we did. You take all that away, and then we are pretty much on target. So, but yeah, it is a tough business.
Very well put. Very insightful. Just to sort of follow up on that example, the example of the first dispensary that we acquired. This question is about the next dispensary that we will open. So I will answer that. And also, how is the business in North Hollywood doing? So just touching on the first part of that question, which is which store will open next. We anticipate that the Westwood store will be open next, the one on Santa Monica Boulevard. This past week, we actually passed local inspection, which is encouraging. The state application has been submitted, although it has not been fully approved yet. It's still in process. And then the local government will have to complete their review of the equity share documents because we are a social equity license. But all in all, the progress has been great, and the store is essentially ready to go from a construction standpoint, just some finishing touches. So we are pretty confident that this store is going to open in Q2. Other than that, though, the North Hollywood business is doing well. The first 2 weeks were more of a soft open while the team basically staffed and trained and tweaked product mix and just made sure everything was in place. And we had 2 grand opening days on Friday and Saturday this past week, and the store was just packed. And customers were coming in and filling up their baskets and hitting their maximum limits for the day in terms of what they could buy. And we're very, very pleased to report that actually the best-selling SKUs in the stores were the Bodega branded products. So we're very pleased with the success of North Hollywood thus far, and we anticipate building on it. In fact, this whole month of April, we'll be doing events on Friday and Saturdays. So we hope that everyone will come by, and we're open every day, and the staff has been great, and Bo and his team has really done an excellent job, and we plan to continue building the momentum on the North Hollywood opening. All right. The next question is the last one regarding dispensaries, so let me just tackle this one. Will the Canadian dispensaries be branded Bodega as well? So our SVP of Retail is definitely considering doing this. We realize that these stores already have a brand in market. They operate under Kushbar. That being said, we're extremely pleased with the rollout, as I was mentioning, of Bodega's branding in LA thus far. The local consumers have reacted well to it. So, what Bodega represents is accessible, friendly cannabis at good value, and we think that that's a great selling proposition wherever you go. We're not, rushing to make that decision, but we're certainly taking a look at rolling this brand out, not just to Canadian dispensaries, but any other market we choose to open stores in. All right. So we're basically through most of these questions. I guess the next question, one for each of you still. Philip, what about the recovery of prices, and if prices had not dropped so precipitously? I think, depending on the product segment, prices were down 25 or 30%, or perhaps even more. What are your thoughts on what our results would have looked like? And if we do see a recovery, what would that mean for us going forward?
Prices have definitely reduced, have come down more than we thought, and I think that we haven't seen the end of that yet. I mean, we, as we know, we looked at this kind of long-term chart for prices in different states some time ago, and that doesn't really show yet that we're at the bottom. And we just keep working at bringing our costs down, and also with the price of trim being down as well. That is the way to maintain your margins. But if prices hadn't come down, then we would have been much more on target. But the reality is that prices continue to decline, and they may well continue to decline. So all we can do is just bring our costs down. That's all I can say about it, really.
Yeah, no, and look, we have to be prepared for the worst, and potentially, Oregon may be more prone to that than California with some of the attrition in the licenses, but even Oregon is making some potential changes in new licensing, and something that we have to track. But it's also why it's important and why we decided it's so important to get scale, because retail prices are less sensitive to market conditions, and decline in prices are experienced more on the manufacturer and cultivation side. So but Philip's absolutely right. We should always look for ways to streamline and cut costs where possible. Okay, so this last question, Kieran, is for you. And so the question is, if all the bodegas open, if we continue spinning out sort of non-core assets that really are standalone or their values better recognized outside of the company, given the example of the Conda too and our shareholding in the Conda, when will the value in Halo be realized and sort of come to light? And what are your thoughts on all of it?
Well, financially, when we file our first quarter, the Conda stake will be marked to market, pretty much, right, Philip? Will there be any discount applied? I don't think so.
That will be that will add $19 million. Like it was $11 million at the year end. That stake is now worth more than $100 million. So and when we do mark to market, we will have a gain in our book value of $90 million,
which makes us right now say we're trading at $20 million US. I mean, we're trading at a 80% discount to our book value, pretty much. Right. And so those situations in my past history don't last very long. Someone will come in and arbitrage it. So I don't see that lasting very long, especially as the economy lockup comes loose. With Halo Tech, we're reducing the number of shares because we're doing a share dividend. So we're actually, anti-diluting. And so using that share dividend technique may actually work well, with other deals we have on the table. But effectively, you're going to see a company by the end of the year that has a growing operation in California, a recovering operation in Oregon, and hopefully 1 to 2 more Conda-like holdings on our books. But yeah, I mean, it's going to be pretty obvious at Q1 that we're trading at an 80% discount to book.
Great. Well, I don't know if Philip or Kieran, that's the end of the questions. I don't know if you have any more comments, anything else that you'd like to add to the presentation?
So people are asking about the convertible note financing with a top line number of $65 million. Our plans right now are only to draw $2.5 million per month to keep that dilution down. People have thought that they make more money or what have you when the stock is low. It's actually a volatility instrument, so they make money when there's more volatility in the stock. And right now, given the stock they have, which is obviously under 9.9%, they're keen to see the stock go up as well. It's to no benefit to them for the stock to go down. And what we're trying to do again is this year be a little bit more conservative, execute on the dispensaries, and implement our spin out strategy with other clusters of assets, and hopefully bring that book value substantially up.
All right. Okay. Well, I think that does it. You can always feel free to reach out to us. Our contact information is on the investor relations page, or contact us on one of our social media channels. And we look forward to hearing from you, and thank you for joining us.